In investing, it's important to know what you are doing. I would even argue that you can only build true wealth if you develop a deep, strong foundation of financial knowledge and financial literacy. As the great Leonardo da Vinci already said, the noble's pleasure is the joy of understanding. So if you don't want to become someone who is financially insecure and financially unsuccessful and then blames external forces for his or her financial disappointments, the economy, his or her job, his or her parents, Wall Street, and so on and so forth, you better get educated. And what better way is there to take responsibility for your own financial education than to familiarize yourself with 7 very common investing terms? So without further ado, let's get started. Alright, so let's jump right into it. So the first investing term that you need to be familiar with is compound interest, because the principle of compounding is arguably the most important concept in investing and personal finance. Put simply, compound interest means interest earning interest. So an investor is earning returns on previous returns. Here's an example. Let's say you have $200 and you take that $200 and put it into some sort of investment. An investment that then earns 10% per year. At the end of year 1, you will have earned $20, bringing your total investment to $220. At the end of year 2, you will earn $22, bringing your total investment to $242, and so on and so forth. And you can probably see where this is going. The longer your money earns compound interest, the more it earns every year. After 40 years, for example, your initial $200 investment will have grown to more than $10,000. So as long as you don't touch your initial investment, it will keep growing. That's why I recommend starting as early as possible, even if you don't have a lot of money to start with. Generally speaking, the earlier you start investing and saving, and the more you save in your early years, the better. Because the power of compounding is so significant in the later years, and the compounding effect will be the strongest in the second and third decade. By the way, compound interest doesn't only affect finances. No, our habits, relationships, knowledge and health, they are also affected by this principle. So my tip is to try to become a little smarter, healthier and more knowledgeable every single day. Moving on to the next term, asset allocation. Asset allocation is a term that is used to describe the process of how to combine different asset classes in order to reduce risk and maximize your gains. It can be boiled down to the following question. Which asset classes will work best for me and how much of each should I hold in my portfolio? So what percentage should I put into the stock market? How much should I put into bonds? What about gold? What about alternative asset classes like, for example, cryptocurrencies? I always say that there are lots of important decisions that you will make when it comes to investing. Active or passive investing, which stocks should you buy, when should you buy, and when should you sell them? How can you avoid taxes and fees? But choosing the right asset class mix is arguably one of the most important investment decisions that you will ever make in your life. And I try to illustrate this in this pyramid chart. Alright, when we are talking about asset allocation, we inevitably also need to discuss the concept of opportunity cost. I would say that when compound interest is the most important concept in all of investing, opportunity cost is probably the second most important one, but at the same time it is probably the most underappreciated concept in all of finance. The textbook definition is that opportunity cost is the value of what you lose when you choose from 2 or more alternatives. It's a concept that can be applied to both life in general, but also to investing. And in investing, your opportunity cost represents the amount of money that you might not earn by purchasing one asset instead of another one. So let's say you want to add a new stock to your portfolio. You always have to make sure that this new investment is better than adding to one of your already existing stocks that is already in your portfolio. The great Charlie Munger once said, if you take the best text in economics by Monkey, he says intelligent people make decisions based on opportunity costs. In other words, it's your alternatives that matter. That's how we, at Berkshire Hathaway, make all of our decisions. To provide one common example here, suppose that instead of investing in an S&P 500 ETF, which historically averaged an annual return of around 10%, you are buying a 10-year treasury yield that is yielding 4% as of today. Even though you don't see the cost when buying that treasury, there is a real economic cost that you are paying for owning an asset, an instrument that provides more certainty and less volatility. We just used the term ETF. So what is actually an ETF? Well, it's quite simply a type of mutual fund that trades on public exchanges, just like a stock of an individual company. So ETFs can be bought and sold during market hours, as I said, just like stocks can. And essentially they are trying to bundle a basket of different assets into one product. So for example, a bundle of stocks, a bundle of bonds or other assets. The main difference between ETFs on the one hand and index funds on the other hand is that index funds can only be traded at the end of a trading day. And ETFs may have lower minimum investments, and you could argue that they are sometimes more tax efficient than index funds. The most common example of an index that is tracked by many ETFs is probably the S&P 500. That's an index that was first introduced in 1957 and that, as of today, tracks the value of the 500 largest publicly traded corporations that are listed on the New York Stock Exchange and the Nasdaq Exchange. Another term that investors should be familiar with, especially when thinking about ETF investments, is expense ratio. The so-called total expense ratio gives investors an idea of how expensive it is to own a specific ETF. It estimates the annual charge that you can expect to pay for holding a specific ETF. And it takes into account various administrative, legal, operational and marketing costs that are incurred by the ETF's management. And generally speaking, try to avoid high expense fees. Alright, next up let's discuss bonds, also known as fixed income securities. Previously we used the term 10-year treasury. Well, a 10-year treasury is a type of a bond, and both governments and companies can issue bonds as a way to raise capital to pay for specific projects or operations. And essentially, you as the bondholder, you lend them money, and in turn, they, the bond issuer, agrees to pay you interest over the lifetime of the bond, the so-called bond yield. And the principal, of course, at the end of the period, which is also known as the bond's face value. The seventh investing term that I cover in this video is dividend. A dividend is quite simply the distribution of a company's profits to its shareholders. If a company generates profits of say $1 million after covering its so-called maintenance capital expenditure requirements, which is the money a firm needs to spend simply to keep its existing plant and equipment in shape so as to maintain the current level of earnings. The company's management then has to decide what to do with that $1 million. And of course, they will have to think carefully about opportunity cost here as well. They can either distribute it directly to shareholders, or they can, use it in some other way. Distributing some of their profits directly to their shareholders only makes sense if they cannot earn a high return on internal investments, or if they can buy back their own stock at attractive prices. So as a consequence, it should be clear that companies are absolutely not required to pay dividends. In this context, let me introduce the term dividend aristocrat. Dividend aristocrats are a special category of dividend paying stocks, which have a very long track record of making and increasing their dividend payouts. More specifically, a dividend aristocrat is a company that has paid and increased its base dividend every single year for at least 25 consecutive years. Now, obviously, there are many more interesting investing terms that we didn't cover in this video. There are literally thousands of terms that I could talk about, but I think this was a great list to get started. And if you want to continuously learn more about investing, just make sure to subscribe to my channel. And if you want to, you can watch the following video next, in which I discuss a common ETF misconception. Take care.